As of last Thursday, the market is bleeding once more. There's red all over and it's starting to look like an early Halloween. Jerome Powell announced a 75-point hike at September's Fed meeting. And like clockwork, the market began to react. Tech stocks are having their worst 2 weeks since the start of COVID. Chinese stocks could see a 20% plunge due to the real estate crisis they're experiencing. And to add on to all of this, the inflation that we are experiencing is causing the lower and middle class to experience a growing pinch. We haven't seen 75-point rate hikes like this since 1994. And just this year, 2022, we've seen not one, not two, but 3 hikes at the 75-point level. The facts are that we are in challenging times. And there's a high level of uncertainty as to whether Jerome Powell is being aggressive enough with the hikes or not. But it's important for us to keep the proper outlook and ensure that we are setting ourselves up as best as we can to take advantage of today's current situation. Thankfully, there are some proven ways to profit in the bear market and to make sure that your financial well-being is protected in these times. In this video, I'm going to talk about some of the things that I'm doing to ensure that I'm protected and making the best of these situations. My hope is that by listening to some of the things that I'm doing, you'll find some clarity in your financial walk and some solutions that will ultimately help you ease some of that anxiety. But before we begin, be sure to hit the like button and subscribe just to put some good karma out into the world. Let's jump right into it. First and foremost, we need to accept the reality that the Fed is going to continue to increase rates until they can get the US consumer to do one thing, and that is to stop spending. You see, the Feds have this lever that they can pull to make sure that they are able to stop the economy from overheating and to make sure that prices don't run away. 9 times out of 10, you're experiencing this in your day-to-day life. Gas prices, food, even your Amazon purchases are going up. While this is a natural thing to happen in our economy, when these prices start to grow out of control, the Feds then begin to increase the rates at which banks can borrow or exchange contracts between each other. This rate, currently between 3 and 3.25%, is the rate at which banks use to do business between each other. This in turn affects the business that's done between us, the US consumers, and the banks. Personal loans, home loans, auto loans, credit card rates, and even the interest that you're paid for just having your money sitting in those banks. The idea is that these increasing costs slow down the economy and really stop people from going out and borrowing and spending money as much. The system isn't perfect because it hurts people at lower income levels, but it's what we got. Right now, Americans are still spending money like crazy. And I think there are 2 reasons why that is still the case. Number 1, the baby boomers and Gen X have already seen this story before. They're out spending money, buying homes, buying new cars and all because they are looking at the prime rate of 6.25% thinking we still have a ways to go before things get totally out of control, right? You see, these generations were around in the 70s when the prime rate was approaching 12%. So a 6.25% rate, they've seen some things. And there is some validity in that outlook. I mean, we are still in negative real rate territory. If you aren't familiar with what a negative real rate is, it's when the inflation interest rate or CPI is greater than the nominal interest rate. For example, the inflation rate came in last month at 8.3%. If we take the real estate market, for example, at this moment currently, if you take out a 30-year fixed rate mortgage, you're gonna be around a mortgage rate of about 6.87%. So if we subtract the mortgage rate from the inflation rate, we get a negative 1.43%. So if you wonder why people are still out here buying these homes at these ridiculous prices, well, you would have had a negative real rate basically all year, with the lowest point being a negative 4.39% this year. These negative real rates are almost like getting paid to borrow money. And until the inflation comes down and the real rate goes positive, people are going to continue to be incentivized to borrow more money to buy homes. The second reason that I believe that America's having a hard time with getting the spending under control is because many of us haven't been thinking about the consequences of overconsumption in the short term due to the very hard times that we endured during the pandemic. With the lockdowns, time out of work, unable to see our families and friends, many people are using this year to do things we've all been wanting to do for quite some time. I've been seeing folks taking vacations they've been putting off, spending time with the older members of their family, and in general just wanting to have a good time. And can you blame them? We have all had a very healthy dose of the not so fun truth about time. It's always fleeting, and once it's gone, you can never get it back. This is data straight from the TSA. People are traveling. They are getting the family. They are going to weddings or that missed honeymoon. The data shows that the people going in and out of airports are getting back to the 2019 numbers. So hopefully that provided you some understanding as to why our economy is so overheated currently. And here's how it's likely affecting you. Stocks are continuing to break new lows with the S&P down 20% for the year, meaning 401ks and brokerage accounts aren't doing too hot right now. Real estate prices are finally starting to fall, but it looks like it's more likely due to the rising interest rates and not because of the lack of demand. Jerome Powell even said in his statements last week that builders are running into issues, finding lots close enough to cities, getting zoning, workers, materials, and lots of other issues. The value of the house may be down, and you might not be facing as much competition when you go to put in an offer. But those monthly interest rates aren't really moving too much currently. With all that being said, this market is not the dot-com bubble, and it is not the financial crisis. So here's how to play it. Having a decent cash reserve should be first and foremost on your priority list. Making sure you got 3 to 6 months of living expenses will help you keep peace of mind and also cover any emergencies that may come up so that you don't tap into your investments. And if you can swing it, making sure that your emergency fund has a little bit of a buffer in case you see some opportunities that may arise during these times. What you don't want to do is go selling your investments in a panic and then being stuck with a ton of cash. While inflation seems to be trending down, you don't want a lot of your net worth being tied up in cash because that really is never a good idea. There's a reason why investors miss out on the largest gains in the market, and it's because they aren't truly in it for the long term. So that leads me to the next point, which is don't panic. Do you want average returns in the market or the best possible return that you can have? The easiest way to start leaving money on the table as an investor is to start thinking that you can time the market and selling at the worst possible moments when the market is down. If you take a look at the S&P 500 over the last 30 years, you can see that there were a lot of times where it looked like it was a good time to sell. This time is no different than those other dips. Things will recover. Stay put, and within the next few years, past data shows that you will very likely be happy that you did. From 1884 to 2020, the average recession lasted 17 months. Can you wait that long? You made it through 2 years of COVID. You absolutely can. Pick an amount of money that you're comfortable investing with on a schedule and continue to invest in reputable mutual funds, index funds, and bonds. This is the time in the market where true wealth can be made. Don't let your fear stop you from taking advantage of these once-in-a-lifetime moments. Buy the dips, buy the days that end up green, and in the next 10 years, you'll be happy that you continued to stick to a plan and follow through. The chart shown here proves that the longer you stay in the market, the greater your chances of a positive return. Add in the fact that you're basically getting a discount currently, and those return percentages are gonna be even higher. So don't be the poor dad that lost it all because he decided to sell when the market was going down in a panic. Be the rich dad that profits and comes out stronger and wealthier than they were before. And that's exactly what I'm doing, dollar cost averaging. I'm still investing the same amount that I would every month, and in some cases increasing that amount depending on what I can do for that month. I'm also making sure that our credit cards are paid off, we aren't experiencing any lifestyle creep, and ensuring that our cash reserves stay healthy. Since we just bought a house earlier this year, we're not looking for any other homes, but we are positioning ourselves so in the next few years we can go and purchase a home out in Heartland, America, where I'm from. Taking these precautions and sticking to well-proven strategies puts me and my family at ease. I'm not trying to find ways to get rich quickly, and we aren't doing anything too rash. Being in big tech working at Microsoft, I have a unique lens into the tech pipeline, and I can tell you that a lot of your favorite companies haven't lost true value. A lot of the price movement that you're seeing with your favorite tech companies is due to external factors, and it doesn't affect the innovation that is happening internally. Our economy is cyclic in nature, and this is just a point in time where we are going through a correction. The truth is, investments can't just continue to go up. There will be some times where we have some bad years, but don't let the news and the current situation get you down. If you are a new investor, now's a great time to start because things are cheap and they have to go up at some point. I have faith in the stock market over the next 10 to 20 years, and to me, this is just all part of the journey. If you found value in this video and you're interested in other topics around wealth creation, be sure to subscribe. And actually, now is a great time to open up a Roth IRA if you haven't already. So be sure to check out that video to help you get started. Thanks for watching.